Here's something nobody tells you when you're broke. There's a specific number that changes everything. It's not $1 million. It's not even 100,000. It's $20,000. $20,000 is the amount that separates people who are surviving from people who are building. It's the difference between being stuck in the game and actually being able to play it. It's the threshold where money stops being just something you need to pay bills and starts being something you can actually use to create more money. And the crazy part? Most people never reach it. They spend their entire lives earning money and spending money, earning and spending, stuck in a cycle that keeps them perpetually broke. They're making $40,000, $60,000, even $80,000 a year, but they never accumulate that critical mass of $20,000 in savings or investable capital. Why? Because nobody taught them that this number matters. Nobody explained that the game fundamentally changes once you cross this threshold. Nobody showed them that wealth isn't built by earning more. It's built by keeping more and then multiplying what you kept. Right now, the median American has about $5,300 in savings. That's it. $5,000. Less than 3 months of expenses for most people. They're one emergency away from financial catastrophe, one car repair away from credit card debt, one medical bill away from bankruptcy. But the people who manage to save $20,000? They're playing a completely different game. They have options. They have leverage. They have the ability to say no to bad opportunities and yes to good ones. They can invest in businesses, delegate tasks, take calculated risks, and build systems that generate passive income. They can afford to think long-term instead of just surviving day to day. $20,000 is enough to start a legitimate business. It's enough to invest in skills that will 10 times your income. It's enough to hire people to do the things you're bad at so you can focus on what you're good at. It's enough to create a buffer that lets you take smart risks instead of desperate ones. In this video, we're going to break down exactly why $20,000 is the magic number, what changes when you hit it, and most importantly, how to get there and what to do once you arrive. By the end, you'll understand why this number is more important than any other financial milestone, including 6 figures, including your first million. Because without 20 grand, you're not building wealth. You're just trading time for money and hoping nothing goes wrong. Let's dive in. Section 1. The Psychology of Having Money. Chapter 1. Why being broke keeps you broke. Let's start with an uncomfortable truth. Being poor is expensive. When you're broke, everything costs more. You can't buy in bulk because you don't have the upfront cash, so you pay more per unit. You can't afford the good shoes that last 5 years, so you buy cheap shoes that fall apart in 6 months and end up spending more over time. You can't afford preventive car maintenance, so you end up paying for expensive emergency repairs. This is called the boots theory of economics. A rich person buys $300 boots that last 10 years. A poor person buys $50 boots that last 1 year. Over 10 years, the poor person spends $500 on boots while the rich person spends $300. Being poor literally costs more. But it's worse than that. Being broke also warps your decision making. When you're living paycheck to paycheck, you're in constant survival mode. Your brain is focused on immediate threats. How do I pay rent this month? What happens if my car breaks down? Can I afford groceries this week? This mental load, economists call it scarcity mindset, actually reduces your cognitive function. Studies show that financial stress reduces your effective IQ by 13 points. That's the difference between average and above average intelligence, just erased by the high stress of being broke. When you're in scarcity mindset, you make short-term decisions because long-term planning feels like a luxury you can't afford. You take the payday loan with the 400% interest rate because you need money now. You stay at the job you hate because switching jobs means a gap in paychecks. You don't invest in education or skills because you can't afford to take time away from earning. This creates a trap. Being broke makes you make decisions that keep you broke, which keeps you in scarcity mindset, which keeps you making poor decisions. It's a cycle that's incredibly hard to break. And here's the really insidious part. When you're broke, other people can exploit you. Your employer knows you can't afford to quit, so they don't have to pay you fairly or treat you well. Lenders know you're desperate, so they charge predatory interest rates. Landlords know you have limited options, so they can raise rent without improving the property. Everyone who has something you need knows you have no leverage and they price accordingly. This is why $20,000 matters. It's not just about the money itself, it's about breaking free from scarcity mindset and gaining leverage. Chapter 2: The Psychological Shift at $20,000. Something changes in your brain when you have $20,000 saved. You stop thinking like a broke person and start thinking like someone building wealth. Your time horizon extends. You can afford to think about next year, not just next week. You can make decisions based on what's optimal rather than what's immediately necessary. This shift is profound. When you have a financial cushion, you think differently about opportunities. A business idea that seemed impossible when you were broke suddenly becomes feasible. A career change that was too risky becomes calculable. An investment that required too much capital becomes accessible. You also negotiate differently. When your boss lowballs you on a raise, you can push back because you're not terrified of losing your income. When a client tries to underpay you, you can walk away because you have a buffer. When someone offers you an opportunity with terrible terms, you can say no and wait for a better one. This is called optionality, having options. And optionality is incredibly valuable. Poor people have no options. They take what's offered because they have to. Middle-class people have some options but are still constrained by monthly obligations. But someone with $20,000 in liquid capital, they have real options. They can wait for the right opportunity instead of jumping at the first one. They can negotiate from a position of strength instead of desperation. They can take intelligent risks that have asymmetric upside, small chance of losing everything, large chance of multiplying their money. The psychological difference between having $5,000 and $20,000 is much larger than the dollar difference would suggest. $5,000 disappears quickly in an emergency. $20,000 gives you breathing room, decision-making space, and the mental bandwidth to think strategically. Chapter 3: The Compound Effect of Not Being Desperate. Here's a concept that changed how I think about money. Desperation is the most expensive emotion. When you're desperate, you make expensive mistakes. You take the first job offer instead of negotiating. You accept unfavorable business terms because you need the money now. You sell assets at the worst possible time because you need cash. You agree to partnerships that give away too much equity because you can't afford to build a loan. Every desperate decision costs you money, opportunity, or both. And when you're broke, you're making desperate decisions constantly. But when you have $20,000, desperation vanishes. Not permanently, you can still run out of money, but long enough to make better decisions. You can afford to wait 3 months for the right job instead of taking the wrong one. Immediately, you can negotiate better terms because you're not pressed for immediate cash. You can walk away from bad deals because your survival doesn't depend on them. This compounds massively over time. Imagine 2 people, both talented, both hardworking. Person A has no savings and makes decisions from desperation. Person B has $20,000 and makes decisions from strength. Person A takes the first job offered, $50,000 per year. Person B negotiates and waits for the right fit, $65,000 per year. Person A accepts a freelance client at $50 per hour because they need the money. Person B holds out for $100 per hour because they can afford to be selective. Person A starts a business but accepts a terrible partnership deal because they need a co-founder who can contribute capital. Person B waits 6 months, finds the right partner, and keeps more equity. Over 5 years, the cumulative difference in earnings and wealth between Person A and Person B is hundreds of thousands of dollars, not because Person B is smarter or works harder, but because Person B isn't making decisions from desperation. This is the compound effect of having money. It's not just about what you can do with the $20,000 itself, it's about all the better decisions you make because you have it. Section 2: The Practical Power of $20,000. Chapter 4: Why $20,000 is the business starting number. Let's get specific. Why $20,000 and not $10,000 or $50,000? Because $20,000 is the minimum amount you need to start most legitimate businesses while maintaining a safety buffer. Here's the math. Most businesses require $10,000 to $15,000 in startup capital. This covers initial inventory, basic equipment, website and branding, initial marketing, legal setup, and a few months of operating expenses. But if you only have $15,000 and you put it all into a business, you're one unexpected expense away from disaster. With $20,000, you can invest $15,000 in the business and keep $5,000 as an Emergency fund. This buffer is psychologically crucial. It lets you take the risk of starting a business without the terror of complete financial ruin if something goes wrong. Let's break down what you can actually start with $20,000 e-commerce business, $10,000 for initial inventory, $2,000 for website and branding, $3,000 for marketing and ads, $5,000 buffer. You can test products, iterate based on feedback, and scale what works. Service business. $5,000 for tools and equipment, $2,000 for website and branding, $3,000 for initial marketing and networking, $10,000 for living expenses while you build the client base. Service businesses are lower capital but require more time to build revenue. Digital product business, $3,000 for software and tools, $2,000 for education and skill development, $5,000 for marketing and audience building, $10,000 buffer. Digital products have the lowest startup costs but require significant skill development. Franchise or existing business. Some smaller franchises or existing businesses can be purchased for $15,000 to $20,000. You're buying a proven model, existing customers, and established systems. The key is that $20,000 gives you enough capital to start something real while maintaining a cushion. You're not betting everything on one roll of the dice. You're making a calculated investment with a safety net. Compare this to starting a business with $5,000. You can technically do it, but you'll be undercapitalized, stressed, and likely to fail because you can't afford the marketing, tools, or time needed to make it work. You'll be back to desperate decision-making, which defeats the whole purpose. Chapter 5: The Delegation Threshold. Here's something successful people understand that broke people don't. Your time has a dollar value, and you should never do tasks worth less than your time. When you're broke, you have to do everything yourself. You clean your own house, prepare your own meals, do your own taxes, manage your own errands. This seems financially responsible. Why pay someone when you can do it yourself? But it's actually keeping you poor. Let's say you earn $50 per hour in your main income-producing activity, whether that's your job, your business, or your freelance work. Every hour you spend on tasks that could be delegated for less than $50 per hour is an hour you're losing money. You spend 2 hours cleaning your house. You saved $60 by not hiring a cleaner. But you lost 2 hours you could have spent earning $100. Net loss, $40. You spend 5 hours doing your taxes. You saved $300 by not hiring an accountant. But you lost 5 hours you could have spent earning $250, plus the accountant would have found deductions you missed, probably saving you more than $300. Net loss, potentially hundreds of dollars. You spend 3 hours per week on administrative tasks, scheduling, and errands. That's 150 hours per year. At $50 per hour, that's $7,500 of lost income. You could hire a virtual assistant for $2,000 per year to handle all of it. Net loss, $5,500. The problem is that when you're broke, you can't afford to delegate. You literally don't have the money to pay someone to do the low-value tasks, so you're trapped doing them yourself, which prevents you from focusing on high-value activities, which keeps you broke. This is another trap. But with $20,000, you can break this cycle. You have enough capital to start delegating strategically. Hire a cleaner for $120 per month. Hire a virtual assistant for $500 per month. Use a meal prep service for $300 per month. Pay an accountant $500 per year. Total annual cost, about $10,000. This frees up approximately 10 to 15 hours per week. That's 600 hours per year. If you use those hours to earn money, build a business, develop skills, or create systems, the return on that $10,000 investment is massive. More importantly, it creates a flywheel. You delegate low-value tasks, which gives you time. For high-value activities, which increases your income, which gives you more capital to delegate more tasks, which frees up more time, which increases your income further. Without the initial $20,000 to start this flywheel, you're stuck doing everything yourself forever. Chapter 6: The Investment Opportunities That Actually Matter. Let's talk about what you can actually invest in with $20,000 that will meaningfully change your financial trajectory. Most personal finance advice is useless for people trying to build wealth from scratch. Max out your 401k. Yeah, great advice for someone making $30,000 who can barely afford rent. Invest in index funds. Cool. Your $2,000 will compound to $2,200 next year. Life-changing. The truth is that traditional investment advice is designed for people who already have money. It's about preservation and modest growth, not about building wealth from nothing. When you have $20,000 and you're trying to build wealth, you need to think differently about investing. You're not trying to preserve capital, you're trying to multiply it. Here are the investments that actually matter at this stage. 1. Investing in skills that 10 times your income. The highest return investment you can make is in skills that dramatically increase your earning power. Sales skills, marketing skills, coding, design, copywriting, video editing, skills that are in high demand and can be monetized immediately. You can invest $5,000 to $10,000 in intensive training, coaching, or courses that teach you a high-income skill. If this skill increases your income from $40,000 to $80,000 per year, that's a 1-year payback period and infinite ROI after that. Compare this to putting $10,000 in the stock market, where you'll make maybe $1,000 per year. The skill investment is 40 times better. 2. Investing in a business. We covered this, but it's worth repeating. Starting or buying a business is the fastest way to multiply $20,000. If you invest $15,000 in a business that generates $5,000 per month in profit, you've made your money back in 3 months and you're generating $60,000 per year in additional income. Even if the business only generates $2,000 per month, that's $24,000 per year, which is a 160% annual return. Try getting that from index funds. 3. Investing in assets that generate cash flow. Real estate is the obvious one, but $20,000 isn't enough for a rental property in most markets. However, you can invest in a small rental property in a low-cost market with creative financing, a partnership in a larger property where you're a minority investor, equipment or assets you can rent out, vehicles, tools, event equipment, a vending machine route or ATM business, digital assets like websites or social media accounts that generate revenue. The key is cash flow. You want assets that generate money monthly, not assets that might appreciate over decades. 4. Investing in people who are better than you. This is the least talked about but potentially highest return investment. You can invest in hiring someone who's better than you at something critical to your business or career. Hire a world-class designer for your product. Hire an expert marketer to build your audience. Hire a skilled developer to build your platform. These people can do in weeks what would take you years to learn and execute. The return on hiring excellent people is often 10 times to 100 times the cost because they compress time and increase quality beyond what you could achieve alone. Chapter 7. The risk-taking calculus changes. When you're broke, you can't afford to take risks. Every decision is binary: succeed or starve. This makes you risk-averse in exactly the situations where you should be taking calculated risks. But when you have $20,000, the risk calculus completely changes. You can afford to take intelligent risks because failure won't destroy you. You have a buffer. You can try something, fail, learn, and try again. This is how wealth is actually built, through experimentation, iteration, and taking asymmetric bets. An asymmetric bet is one where the downside is limited but the upside is massive. You risk a small amount of money, but if it works, the return is 10 times, 50 times, or 100 times. Examples: starting a side business. Risk $5,000 and 6 months of effort. Worst case, you lose $5,000 and learn valuable lessons. Best case, you build a business that generates $10,000 plus per month and eventually replaces your job. Investing in a high-value skill. Risk $3,000 in 3 months. Worst case, you learn something useful but don't immediately monetize it. Best case, you 2 times or 3 times your income permanently. Angel investing in a friend's startup. Risk $5,000. Worst case, you lose the money but maintain the relationship and learn about startups. Best case, the company succeeds and your $5,000 becomes $50,000 or more. Creating a digital product, risk $2,000 and your time. Worst case, nobody buys it and you learn what doesn't work. Best case, you create an asset that generates passive income for years. When you're broke, these bets are terrifying because losing $5,000 could mean not making rent. But when you have $20,000, losing $5,000 is painful, but not catastrophic. You can take the bet, and if it doesn't work, you still have $15,000 and the knowledge you gained. This is how wealth compounds. You take multiple small asymmetric bets. Most fail or break even, but one or two succeed massively, and those wins more than compensate for all the losses. Broke people can't play this game. They're stuck with symmetric bets where the risk and reward are roughly equal, trading time for money, which never leads to wealth. Having $20,000 gives you permission to play the asymmetric game, which is the only game worth playing if you want to build real wealth. Section 3, the opportunity door opens. Chapter 8, access to different circles. Here's something that sounds superficial, but is actually crucial. When you have $20,000, you get access to different rooms. Wealth creation happens in rooms that broke people aren't invited to. It happens in masterminds, investment groups, business partnerships, and networking events that have barriers to entry. These barriers aren't always explicit. There's no bouncer checking your bank account at the door, but they exist. When you're broke, you can't afford to. Join the $5,000 mastermind where successful entrepreneurs share strategies. Attend the $2,000 conference where deals are made. Invest in the group buying opportunity that requires $10,000 minimum. Participate in the real estate syndication that needs $25,000, but you could partner with someone. Hire the $10,000 consultant who could compress 10 years of learning into 6 months. These aren't just expenses, they're admission tickets to environments where wealth is created. Let me give you a concrete example. There's a phenomenon in business called a deal flow. Deal flow is access to opportunities before they're public. The best investments, partnerships, and business opportunities never make it to the general market. They're shared within networks of people who have resources and credibility. When you have $20,000 and you're strategically positioned, you start getting deal flow. A friend mentions they're raising money for a business and offers you equity for $10,000. Someone in your network is selling a profitable online business for $15,000. A real estate investor offers you a partnership where you put in $20,000 and they handle everything. An entrepreneur needs capital for inventory and offers you 15% of their business. None of these opportunities are advertised on AngelList or Craigslist. They happen in conversations between people who trust each other and know each other have resources. When you're broke, you're excluded from these conversations. Not maliciously, people just assume you can't participate, but when you have capital and you're in the right rooms, opportunities find you. The key is being strategic about which rooms you enter. Don't just attend expensive events randomly. Target communities where your ideal opportunities circulate. If you want to learn e-commerce, join e-commerce masterminds. If you want real estate deals, join real estate investment groups. If you want high-value clients, go where they congregate. The $20,000 isn't just for the membership fee, it's social proof that you're serious, and it's capital you can deploy when the right opportunity appears. Chapter 9. The credibility factor. Let's talk about something uncomfortable. Money gives you credibility, whether it should or not. When you pitch a business idea with no money, people see you as a dreamer. When you pitch the same idea with $20,000 to invest, people see you as a serious entrepreneur. The idea didn't change. Your credibility did. This applies everywhere. In partnerships, if you approach someone about starting a business together and you have no capital, they assume they'll be funding everything and you'll contribute sweat equity. They'll want majority ownership. But if you can contribute $10,000 to $15,000, suddenly you're a real partner who's sharing risk. You negotiate from equality. With vendors and suppliers, try negotiating favorable terms with a supplier when you're placing a $500 order versus a $5,000 order. The $5,000 order gets you bulk pricing, better payment terms, priority service, and the supplier's attention when you have problems. With clients, when you have capital, you can invest in looking professional, quality website, good branding, case studies, portfolio pieces. This attracts better clients who pay more. Broke entrepreneurs look broke, which attracts broke clients or no clients at all. With investors and lenders, banks won't lend to you if you have no skin in the game, but if you're starting a business and you've invested $10,000 of your own money, suddenly you're eligible for a $30,000 small business loan. Your $10,000 just became $40,000 in total capital. This is called leverage, and it's one of the most powerful concepts in wealth building. You use your money to access other people's money, expertise, or opportunities. Here's a specific example. Let's say you want to start a marketing agency. Scenario A, no capital. You create a free website on Wix, You reach out to small businesses on Facebook. You offer low prices to get your first clients. You look desperate and unprofessional. You attract clients who want cheap work, haggle over prices, and don't respect your time. You struggle for months to get traction. Scenario B, $20,000 in capital. You invest $3,000 in a professional website and branding. You spend $2,000 on case studies and portfolio development. Maybe you do free or discounted work for impressive brands just to get testimonials. You invest $5,000 in targeted advertising and content marketing. You keep $10,000 as operating buffer. Now, when you reach out to clients, you look established. Your website is professional. You have impressive case studies. You're running ads, which signals credibility. Clients assume you're successful, which makes them want to work with you, which makes you actually successful. The business is the same, the entrepreneur is the same, but the second version has credibility, which becomes a self-fulfilling prophecy. Chapter 10. The time buying factor. Money doesn't buy happiness, but it absolutely buys time. And time is the only non-renewable resource. When you're broke, you're forced to do everything the slow way. You can't hire help, so tasks take longer. You can't pay for tools and software that automate work. You can't afford courses that compress learning. You can't outsource the grunt work to focus on high-value activities. This keeps you trapped in low-productivity activities. You're busy all the time, but not moving forward. With $20,000, you can buy time systematically. Software and tools. $200 per month for tools that automate email marketing, scheduling, customer management, bookkeeping, and social media. These tools save you 15 to 20 hours per week. That's 900 hours per year, the equivalent of an entire full-time job. Virtual assistants, $500 to $1,000 per month for a VA who handles email, scheduling, research, basic admin work. This frees up another 20 hours per week for you to focus on revenue-generating activities. Done-for-you services. Need a website? Hire a developer instead of spending 100 hours learning to code and building something mediocre. Need marketing? Hire an expert instead of spending months figuring it out. Need content? Hire writers, designers, and video editors. The pattern is clear. Broke people trade time for money. Wealthy people trade money for time. When you're broke, you think, I can't afford to pay someone $1,000 to build my website, but you don't calculate the opportunity cost of spending 80 hours building it yourself. If your time is worth $50 per hour, you just spent $4,000 in opportunity cost to save $1,000 in cash. That's a terrible trade. When you have $20,000, you can make the intelligent trade. Pay $1,000 for the website, use your 80 hours to generate revenue, acquire customers, or develop skills. This accelerates everything. Here's the compounding effect. Let's say you have 40 hours per week to work on your business. Without capital, 20 hours on low-value tasks, admin, website building, basic design work, 20 hours on high-value tasks, sales, strategy, product development. Progress is slow. With capital, you delegate the 20 hours of low-value tasks for $2,000 per month. Now you have 40 hours for high-value tasks. Your productivity doubles. Your revenue increases faster. You can delegate even more. Your productivity triples. The person without capital works harder but moves slower. The person with capital works smarter and accelerates exponentially. This is why rich people seem to get richer effortlessly. They're not smarter or more talented. They're just buying time at scale and using that time to create more wealth. Chapter 11. The Learning Acceleration. One of the biggest advantages of having $20,000 is that you can compress years of learning into months. When you're broke, learning is slow. You watch free YouTube videos, you read blogs, you figure things out through trial and error. This works, but it takes forever. You waste years making mistakes that someone could have warned you about. When you have capital, you can accelerate learning dramatically. High-end courses and coaching. A $5,000 course taught by someone who's already achieved what you want to achieve is worth it if it saves you 2 years of trial and error. Most people balk at the price, but they don't calculate the value of time saved. Let's do the math. You want to build a 6-figure online business. You can figure it out yourself through free content over 3 to 4 years, or you can pay $5,000 for a comprehensive course and coaching that gets you there in 12 to 18 months. The course saves you 2 to 3 years. If your time is worth even $25 per hour, that's $50,000 plus in value. The $5,000 course is a 10 times return on investment just from time saved. not even counting the increased revenue from getting there faster. Masterminds and peer groups. Joining a $5,000 to $10,000 mastermind puts you in a room with people who are ahead of you. You learn from their mistakes without having to make them yourself. You get feedback on your plans before you waste months pursuing bad ideas. You get introduced to opportunities you'd never find alone. Consultants and experts. Hiring a $200 per hour consultant for 10 hours costs $2,000. But that consultant can audit your business, identify what's not working, and give you a specific action plan. This saves you months of trying random tactics and wondering why they're not working. Conferences and events. A $2,000 conference ticket seems expensive until you make one connection that turns into a $50,000 opportunity or learn one strategy that increases your revenue by $10,000 per month. The pattern is clear. Free learning is slow, paid learning is fast. When you're broke, you can only afford slow learning. When you have $20,000, you can afford to accelerate. This compounds massively because skills are permanent. Once you learn high-value skills, you have them forever. The faster you acquire these skills, the longer you have to use them to generate wealth. Two people start at the same point. Person A takes 4 years to figure out how to build a successful business through free content and trial and error. Person B invests $10,000 in accelerated learning and figures it out in 18 months. Person B has a 2.5-year head start. Over a 30-year career, this head start is worth millions of dollars in additional earnings and compounding. Chapter 12, The Passive Income Foundation. Here's the real secret about $20,000. It's enough to build systems that generate money while you sleep. Passive income is the holy grail of wealth building. It's money that comes in whether you work or not. Most people never build passive income because they never accumulate enough capital to create the systems that generate it. With $20,000, you can build passive income streams that change your financial life. Digital products, invest $5,000 in creating a course, ebook, template pack, or software tool. This is a one-time investment that can generate revenue for years. Once it's created, every sale is nearly pure profit. You can make $500 to $5,000 per month from a digital product that requires minimal maintenance. Content that generates ad revenue, invest $8,000 in creating a YouTube channel, blog, or podcast. Pay for equipment, editing, and initial content creation. Once you hit monetization thresholds, the content generates ad revenue, sponsorships, and affiliate income indefinitely. Successful content creators make $2,000 to $20,000 plus per month from content they created months or years ago. Automated e-commerce. Invest $15,000 in setting up a dropshipping or print-on-demand business with proper automation. Use tools to handle customer service, fulfillment, and marketing. Once the system is running, it generates revenue with minimal daily involvement, dividend investments, or cash-flowing assets. While $20,000 isn't enough to retire on investment income, it's enough to start generating meaningful cash flow. At a 6% annual return, $20,000 generates $1,200 per year or $100 per month. That's not life-changing, but it's the beginning of a snowball. Rental income. In some markets, $20,000 is enough for a down payment on a rental property. If the property generates $300 per month in positive cash flow, that's $3,600 per year. After a few years, you can refinance, pull out your initial investment, and repeat the process. The key insight is this: active income, trading time for money, has a ceiling. You only have so many hours in a day, but passive income has no ceiling. You can build multiple streams that each generate $500, $1,000, or $5,000 per month, and they compound together. With $20,000, you can build your first passive income stream. Then you can reinvest the profits to build a second stream, then a third. Within 3 to 5 years, you could have 5 passive income streams, each generating $2,000 to $5,000 per month. That's $10,000 to $25,000 per month without actively working. This is impossible to do when you're broke, because you can't afford the initial investment to build the systems. But with $20,000, you can start the flywheel that leads to financial freedom. Section 4. The Strategic Advantages. Chapter 13. Negotiation Leverage. Let's talk about a truth that nobody wants to admit. Negotiation outcomes are determined by who needs the deal more. When you're broke, you always need the deal more. You need the job, so you accept the salary they offer. You need the client, so you accept their low rate. You need the sale, so you give a discount. You're negotiating from weakness, and everyone knows it. But when you have $20,000 in the bank, you can walk away from any deal. And the ability to walk away is the most powerful negotiating tool in existence. In salary negotiations, when you have no savings and bills are due, you can't afford to say no to a job offer. If they offer $60,000 and you want $75,000, you'll probably accept the $60,000 because you need income immediately. But if you have $20,000 saved, you can afford to be patient. You can say, I appreciate the offer, but I'm looking for $75,000 based on my experience and the market rate. I'm happy to wait for the right opportunity. Many companies will increase their offer when they realize you're willing to walk. Even if they don't, you can afford to keep looking until you find someone who will pay your rate. Over a career, this difference compounds into hundreds of thousands of dollars. Every job change where you negotiate from strength instead of desperation increases your lifetime earnings. In client negotiations, freelancers and service providers constantly undercharge because they're afraid of losing the client. A client offers $50 per hour, you want $100 per hour, but you accept $50 because you need the money. With a financial cushion, you can hold your rate. My rate is $100 per hour based on the value I provide. I understand if that doesn't fit your budget, and I'm happy to refer you to someone who might be a better fit. Two things happen. Either the client accepts your rate, many will, or they don't, and you're freed up to find clients who will pay what you're worth. Without the cushion, you'd have accepted the $50 rate and been stuck in a low-paying engagement for months. In business deals, when you're starting a business and have no capital, you're forced to accept unfavorable terms. A potential partner offers to invest $20,000 for 50% of the company. You don't want to give up half your business, but you need the capital, so you accept. But if you have your own $20,000, you don't need their investment. You can negotiate from strength. I'm looking for a partner who brings strategic value, not just capital. I'm offering 20% equity for the right partner who can provide X, Y, and Z. The difference between 50% and 20% equity in a successful business is millions of dollars. The $20,000 you saved is the reason you get to keep that equity. Chapter 14, the ability to be patient. Patience is a luxury of the wealthy. When you're broke, you can't afford to wait for the right opportunity. You have to take whatever's available now. This impatience costs you enormously over time. In investing, when you need money immediately, you sell assets at the worst possible time. The stock market crashes, you panic and sell at the bottom because you need cash. Meanwhile, wealthy people with cushions buy at the bottom and get rich. With $20,000 saved, you can afford to hold investments through downturns. You can wait for the right buying opportunities instead of buying whatever's available. You can make long-term bets that take years to pay off. In career moves, the best career opportunities often require patience. Maybe your dream company is hiring but won't decide for 2 months. Maybe you need to take a temporary pay cut to switch industries, but it leads to higher pay long-term. Maybe you need to relocate, which requires time to plan and execute. Broke, people can't afford this patience. They need income next week, so they take whatever job is available now. They stay in careers they hate because switching requires a gap in paychecks. With a financial cushion, you can afford strategic patience. You can wait for the right role, take short-term pay cuts for long-term gains, and invest time in transitions that position you better. In business, building. Most businesses take 12 to 18 months to become profitable. During that time, you're investing money and effort with no immediate return. Broke people can't sustain this. They need revenue immediately, so they make short-term decisions that undermine long-term success. They underpriced services to get quick clients. They pivot, constantly chasing fast money. They can't invest in marketing that takes months to pay off. They're stuck in survival mode. With $20,000, you can afford to play the long game. You can invest 6 months in building a proper foundation, great product, solid marketing, strong systems, before aggressively pursuing revenue. The business you build is stronger because you weren't forced into desperate short-term decisions. Chapter 15. The power of saying no. Here's a counterintuitive truth. Success comes more from what you say no to than what you say yes to. Warren Buffett said, The difference between successful people and very successful people is that very successful people say no to almost everything. When you're broke, you can't say no. Every opportunity seems like it might be the one that saves you, so you say yes to everything. The client who pays terribly but it's money, the partnership that gives you bad terms but at least it's something, the job that's not quite right but you need income, the project that's outside your expertise but you can't afford to turn down work. Saying yes to everything means you're constantly busy but not moving forward. You waste time on low-value activities. You build a business around bad clients instead of good ones. You dilute your focus across too many things. You never build real expertise because you're always doing different things. But when you have $20,000, you can afford to be selective. You can say no to clients who are difficult, don't pay well, or aren't aligned with where you want to go. Opportunities that seem good but distract from your main goal. Partnerships where the terms aren't right. Projects that don't build the reputation or skills you want. Every no creates space for a better yes. When you say no to the $50 per hour client, you create time to find the $150 per hour client. When you say no to the bad partnership, you're available when the right partner appears. When you say no to the job that's not quite right, you can wait for the perfect fit. This is called strategic focus, and it's impossible when you're in survival mode. But with a financial buffer, you can afford to be focused and selective, which accelerates your progress massively. Chapter 16. Multiple bets at once. Here's an advantage of having $20,000 that most people miss. You can make multiple bets simultaneously. When you're broke, you can only afford one bet at a time. You start one business and hope it works. You pursue one strategy and pray it pays off. If it fails, you're back to zero. This is incredibly risky because most first attempts fail. The entrepreneurs who succeed usually failed 2 to 3 times first. The business owners who are profitable now went through several unsuccessful ventures. The successful people you admire took multiple shots before they hit, but broke people don't get multiple shots. They take one swing, it doesn't work, and they're out of money and opportunity. With $20,000, you can take multiple simultaneous bets. Strategy A, portfolio approach. Instead of investing all $15,000 in one business, invest $5,000 in 3 different businesses. 2 fail, 1 succeeds, and that one success more than compensates for the failures. Strategy B, parallel paths. Keep your job for now, income stability, while investing $10,000 in starting a side business. You're reducing risk while still betting on upside. Strategy C, skill diversification. Instead of learning 1 skill, invest in learning 3. $3,000 for copywriting, $3,000 for paid advertising, $3,000 for email marketing. You're not sure which will be most valuable, so you learn all 3. Whichever proves most lucrative becomes your focus. Strategy D, market testing. You have an idea but aren't sure if it'll work. Instead of investing everything, spend $3,000 testing the concept with a minimal viable product. If it works, invest more. If it doesn't, you've only lost $3,000 and you can try something else. The key is that you're not betting everything on one outcome. You're creating optionality, multiple paths to success so that if one doesn't work, others might. This is how venture capitalists operate. They know most investments will fail, so they make 20 to 30 investments knowing that 2 to 3 massive wins will more than cover all the losses. You can apply the same logic on a smaller scale with $20,000. Broke people are forced to make concentrated bets, which is high risk. People with capital can make diversified bets, which is lower risk with similar upside potential. 8:12 p.m., Section 5, The Wealth Building Mechanics. Chapter 17, Understanding the Velocity of Money. Let's talk about a concept that separates people who stay at $20,000 from people who turn it into $200,000, the velocity of money. Velocity of money is how quickly money moves through different uses to create value. Broke people think of money as something you spend and it's gone. Wealthy people think of money as something that moves through multiple uses before it's spent. Here's what I mean. Broke person's money flow. Earn $1,000 to spend $1,000 on expenses to money is gone. Wealthy person's money flow. Earn $1,000 to invest $1,000 in a skill that increases income to. That skill generates an additional $500 per month to invest that $500 in a business to that business generates $1,000 per month to use part of that to improve the business and part for expenses. The same $1,000 created multiple layers of value before any of it was consumed. With $20,000, you can start optimizing for velocity. Example 1. The equipment. Play. You have $5,000. You buy professional camera equipment. You use that equipment to create content for your YouTube channel. The channel grows and generates $1,000 per month in ad revenue. You also rent out the equipment when you're not using it for $500 per month. You also use it to offer video services to clients for $2,000 per month. Your $5,000 is now generating $3,500 per month through 3 different uses. The money hasn't been spent, it's been deployed, and it keeps generating returns. Example 2, the education multiplier. You invest $3,000 in learning Facebook advertising. You use this skill to run ads for your own business, generating $5,000 per month in additional revenue. You also offer your services to 3 clients at $2,000 per month each. You also create a course teaching what you learned and sell it for $2,000 per month. Your $3,000 investment is now generating $13,000 per month through 3 different applications of the same skill. Example 3, the relationship leverage. You invest $5,000 joining a high-level mastermind. In the mastermind, you meet someone who becomes a business partner. Together, you start a business that generates $10,000 per month profit. You also meet someone who refers $20,000 worth of clients to you. You also learn strategies that increase your existing business revenue by $3,000 per month. Your $5,000 created $33,000 plus in value through relationships and knowledge gained. The pattern is clear. When you have capital, you can invest it in ways that create multiple streams of value simultaneously. The money isn't consumed, it's deployed strategically to generate returns far exceeding the initial investment. Broke people can't do this because they don't have the capital to deploy. Every dollar they earn must go to immediate expenses. The money flows in one direction, in and out. But with $20,000, you can start moving money strategically through multiple uses, each creating value before any of it gets consumed. This is how you turn $20,000 into $100,000 in 2 to 3 years. Chapter 18. The arbitrage opportunities. Arbitrage is buying something in one market and selling it in another market where it's worth more. Most people think arbitrage only applies to stocks or currencies, but it applies to everything, and $20,000 is enough to start exploiting arbitrage opportunities that build serious wealth. Time arbitrage. You can hire skilled people from low-cost countries for $10 to $20 per hour and sell their output in high-cost markets for $100 to $200 per hour. A virtual assistant from the Philippines costs $5 per hour. You package their services and sell them to U.S. businesses for $50 per hour. You're arbitraging the difference in labor costs between markets. With $5,000, you can hire a team of 3 to 4 people and start a service business with almost no overhead. You're capturing the spread between what you pay and what you charge. Skill arbitrage. You invest $3,000 learning a high-value skill. This skill is worth $20 per hour in the learning phase, but $100 per hour once you're competent. You're arbitraging your time, trading low-value time now for high-value time later. Information arbitrage. You spend $2,000 on courses and coaching learning strategies that work in your industry. Most people in your industry don't know these strategies. You use them to get results that others can achieve. You're arbitraging information. You know something valuable that others don't. Attention arbitrage. You identify a platform where attention is cheap, maybe a new social media platform or an undervalued advertising channel. You invest $5,000 building an audience there before everyone else catches on. Once the platform matures, that audience is worth $50,000 plus. You arbitraged attention when it was cheap. Product arbitrage, classic buy low, sell high, but with sophistication. You find products that are undervalued in one marketplace and overvalued in another. You buy for $30, sell for $90, capture the $60 spread. With $10,000 in capital, you can move significant volume and generate $5,000 to $10,000 per month in profit. The key to arbitrage is identifying inefficiencies, places where value is mispriced. These inefficiencies exist everywhere, but you need capital to exploit them. The more capital you have, the more arbitrage opportunities you can execute simultaneously. Chapter 19. The Compounding Acceleration. Everyone talks about compound interest, but most people think about it wrong. They think, if I invest $20,000 at 8% per year, in 30 years I'll have $200,000. Cool, you'll be rich when you're old. That's not how wealthy people think about compounding. Wealthy people think about compounding in multiple dimensions. 1. Skills compound. Every skill you learn makes the next skill easier to learn. Learn marketing, then learning sales is easier. Learn sales, then learning persuasion is easier. Each skill builds on previous skills, and your learning accelerates. With $20,000, you can invest in your first 2 to 3 high-value skills. These skills compound over your entire career. The copywriting you learn at 25 makes you millions more over 40 years. 2. Relationships compound. Every valuable relationship creates access to more valuable relationships. You meet one successful entrepreneur, they introduce you to 5 more. Those 5 introduce you to 25 more. Your network grows exponentially, and with it, your opportunities. With $20,000, you can invest in joining communities and attending events that put you in rooms with valuable people. These relationships compound into opportunities for decades. 3. Reputation compounds. Every success makes the next success easier. You complete one project well, you get a testimonial, which helps you land a bigger project, which creates a better testimonial, which attracts even bigger opportunities. Your reputation builds on itself. With $20,000, you can invest in creating impressive early work, maybe taking lower-paying projects with high-profile clients just to build case studies. These case studies compound into bigger opportunities. 4. Systems compound. Every system you build makes future systems easier to build. You create a system for finding clients, then a system for onboarding them, then a system for delivering work, then a system for getting referrals. Each system reduces friction and increases efficiency, and they all work together. With $20,000, you can afford to invest in building proper systems from the start, instead of constantly firefighting. 5. Capital compounds. This is the traditional compound interest, but it works faster when you're actively deploying capital in high-return opportunities. You make $5,000 profit from one investment, you reinvest it in another, you make $7,000, you reinvest, you make $10,000. The compounding accelerates because you're learning what works and getting better at deploying capital. The magic happens when all 5 types of compounding work together. Year 1. You invest $5,000 in skills. Those skills generate $3,000 per month additional income. You invest $2,000 per month back into the business and keep $1,000 for expenses. Year 2. Your improved skills and systems generate $7,000 per month. Your reputation has grown, so better opportunities find you. You invest $5,000 per month back in, growing faster. Year 3. You're generating $15,000 per month. Your network has expanded dramatically. Your systems run smoothly. Your reputation attracts premium clients. You invest $10,000 per month in expansion. By year 3, you've turned $20,000 into a business generating $180,000 per year, and it's accelerating. This isn't compound interest at 8%. This is compound growth at 200 to 300% because you're compounding across multiple dimensions. Chapter 20. The emergency buffer that enables aggression. Here's a paradox. Having money saved makes you more willing to take risks. You'd think it would be the opposite. People with money would be conservative and protective. But the reality is that a financial buffer allows you to be strategically aggressive. When you're broke, every decision feels life or death. You can't take aggressive business moves because failure means you can't pay rent. You can't invest heavily in marketing because if it doesn't work, you're ruined. You can't leave your job to pursue an opportunity because you need consistent income. This forced conservatism keeps you stuck. But when you have $20,000 saved, you can be selectively aggressive. Aggressive marketing. You can invest $5,000 in a marketing campaign that might not work. If it fails, you're not destroyed. You learn what doesn't work and try something else. If it succeeds, you've found a channel that might generate millions in revenue over time. Most businesses fail because they're undercapitalized and can't afford to test marketing channels properly. They try something once, It doesn't work immediately, they can't afford to iterate, and they give up. With capital, you can test 5 to 10 different channels until you find what works. Aggressive hiring. You can hire someone who's slightly above your current level, betting that they'll help you grow into bigger opportunities. This is expensive in the short term, but accelerates growth dramatically. Broke entrepreneurs can only afford to hire people cheaper than themselves, which means they're always the most skilled person in the business, which limits growth. With capital, you can hire people better than you, which unlocks new capabilities. Aggressive pricing. You can charge premium prices and turn away clients who won't pay. This feels risky. What if you lose too many clients? But premium pricing attracts better clients, increases perceived value, and ultimately generates more revenue with fewer headaches. Without a buffer, you can't afford to lose any clients, so you keep prices low and work with difficult clients. With a buffer, you can be selective and premium. Aggressive niche focus. You can specialize narrowly in a specific niche instead of being a generalist who takes any work. Specialization is risky short-term, fewer opportunities, but highly profitable long-term. You become the expert and can charge accordingly. Broke people can't afford to narrow their focus because they need any work they can get. People with buffers can specialize, become known for something specific, and eventually dominate their niche. The pattern is clear. A financial buffer doesn't make you conservative. It enables intelligent aggression. You can take calculated risks, invest in growth, and make bold moves because failure won't destroy you. This is why people with money often make more money faster. They're not more talented, they can just afford to be aggressive in ways that broke people can't. Chapter 21. The Psychological Freedom. Let's talk about something that's not directly financial, but impacts everything. Psychological freedom. When you have $20,000, something shifts. In your psychology, you stop operating from fear and start operating from possibility. Fear-based decisions. Taking a job because you're afraid of being unemployed, staying in a relationship because you're afraid of being alone, not pursuing opportunities because you're afraid of failure, keeping prices low because you're afraid clients will leave, saying yes to everything because you're afraid of missing out. Possibility-based decisions. Taking a job because it aligns with where you want to go, staying in a relationship because it adds value to your life, pursuing opportunities because the upside is compelling, charging premium prices because you're confident in your value, saying no to most things so you can say yes to the right things. The difference is massive. Fear-based decisions are reactive and defensive. Possibility-based decisions are proactive and strategic. When you're broke, you're making fear-based decisions constantly. Your entire life is organized around avoiding negative outcomes. This creates a psychological weight that affects everything: your confidence, your relationships, your health, your happiness. When you have $20,000, the psychological weight lifts. You're not rich, but you're not desperate. This changes how you show up in the world. In negotiations, you're calm and confident instead of anxious and needy. People sense this and they treat you differently. They respect you more, trust you more, and are more likely to give you what you want. In business, you make better strategic decisions because you're not panicking about short-term survival. You can think long-term, invest in quality, and build something sustainable. In relationships, you attract better partners because you're not desperate for validation or financial support. You can choose partners based on compatibility rather than need. In opportunities, you evaluate opportunities based on merit rather than desperation. You can see red flags clearly, instead of convincing yourself something is good because you need it to be. This psychological freedom is worth more than the $20,000 itself. It changes your entire trajectory because it changes how you make every decision for the rest of your life. Section 6. The Practical Playbook. Chapter 22. How to actually get to $20,000. Alright, we've spent most of this video talking about what changes once you have $20,000. But how do you actually get there? This is the hard part, and I'm not going to sugarcoat it. Saving $20,000 when you're starting from zero is difficult. But it's not impossible, and people do it all the time. Here's the realistic path. Step 1. Audit your current spending ruthlessly. Most people have no idea where their money goes. They earn $3,000 per month, spend $3,000 per month, and wonder why they never get ahead. Track every expense for 1 month, every coffee, every subscription, every impulse purchase. You'll be horrified. Most people waste $500 to $1,000 per month on things that add zero value to their lives. Common money leaks: $200 per month on food delivery when you could cook $100 per month on subscriptions. You don't use $300 per month on a car payment when you could drive something cheaper. $150 per month on entertainment. You don't really enjoy $200 per month on clothes you don't need. That's $950 per month right there. Cut half of it, and you're saving $475 per month. That's $5,700 per year. Step 2. Increase income aggressively. Cutting expenses helps, but there's a limit to how much you can cut. Income has no limit. If you're employed, ask for a raise. Most people never ask. Switch jobs. Job switching increases income 10 to 20% on average. Get a promotion by doing work above your pay grade. Develop skills that make you more valuable. If you're entrepreneurial, start a side hustle, freelancing, consulting, e-commerce. Monetize a skill you already have. Create a digital product, course, ebook, templates. Offer services to businesses that pay. Well, even an extra $500 per month from a side hustle is $6,000 per year. Combined with the expense cutting, you're now saving $11,700 per year. Step 3. Automate the savings. Willpower doesn't work. You need systems. Set up automatic transfers the day you get paid. If you never see the money in your checking account, you won't spend it. Pay yourself first. The moment money hits your account, $500 automatically moves to a separate savings account. You learn to live on what's left. Step 4. Resist lifestyle inflation. When you get a raise or your side hustle starts making money, don't increase spending proportionally. Keep living like you did before and save the difference. If you get a $10,000 raise, don't buy a nicer car or upgrade your apartment. Save $8,000 of it and allow yourself a small lifestyle improvement with the other $2,000. Step 5. Use windfalls strategically. Tax refunds, bonuses, gifts, selling stuff you don't need, all of these should go directly to savings. Most people immediately spend windfalls on things they don't need because it feels like free money. It's not. It's your ticket to $20,000. The math: save $500 per month from cutting expenses, $6,000 per year, earn $500 per month from side hustle, $6,000 per year, tax refunds/bonuses, $2,000 per year, total $14,000 per year. You'll hit $20,000 in 17 months, less than 2 years. Is it easy? No. Does it require sacrifice? Yes. Will you have to say no to things your friends are doing? Absolutely. But it's possible, and the payoff is life-changing. Chapter 23. What to do. Once you hit $20,000. Congratulations, you've saved $20,000. Now comes the critical part. What you do with it determines whether you build wealth or just have a nice emergency fund. Here's the framework. Split it strategically. Keep $5,000 to $7,000 as emergency fund. This is untouchable except for genuine emergencies. This gives you 3 to 4 months of essential expenses, enough to weather most crises without going into debt. Invest $8,000 to $10,000 in income-producing assets. This is money you're actively deploying to generate returns. This could be starting or scaling a business, investing in skills that increase your income, buying equipment or assets you can rent out, investing in opportunities with clear RO. I keep $5,000 as opportunity capital. This is money you can deploy quickly when the right opportunity appears. Maybe a friend's business needs a partner, maybe you find an undervalued asset, maybe you discover a proven business model you can replicate. You need liquid capital to act fast. The biggest mistake people make: they save $20,000 and then get scared. They put it all in a savings account or low-yield investments and feel proud of themselves for being financially responsible. This is a trap. At 1% interest, your $20,000 becomes $20,200 in a year. You've gained $200 while missing dozens of opportunities that could have 5 to 10 times your money. The whole point of saving $20,000 isn't to have money sitting in a bank. It's to have capital you can deploy strategically to generate returns far exceeding what any savings account will give you. Yes, keep some in reserves for emergencies, but deploy the majority aggressively. You're young, probably. You can afford to take calculated risks, and the potential upside is enormous. Chapter 24. Common mistakes to avoid. People finally get to $20,000 and immediately make mistakes that destroy the opportunity. Let's talk about what not to do. Mistake number 1, lifestyle inflation. You hit $20,000 and suddenly feel rich. You upgrade your car, move to a nicer apartment, start eating out more. Within 6 months, the $20,000 is gone and you're back to living paycheck to paycheck, just at a higher expense level. Don't do this. Keep living like you did when you were saving. Let the $20,000 work for you, not get consumed by slightly nicer stuff that doesn't actually make you happier. Mistake number 2, letting it sit idle. The opposite. Mistake. You're so scared of losing it that you don't deploy it at all. You've worked hard to save it, and now you're paralyzed by the fear of making a wrong move. Money that sits idle loses value to inflation. Worse, it represents missed opportunity cost. Every month you don't deploy the capital is a month you could have been generating returns, learning, building systems, or creating assets. Mistake number 3, betting it all on one thing. Some people save $20,000 and then invest all of it in a single opportunity. A business, a stock tip, a real estate deal. This is the opposite of diversification, and it's incredibly risky. If that one thing fails, you're back to zero. Better to make 3 to 4 smaller bets so that if 1 or 2 fail, the others can still succeed. Mistake number 4, investing in things you don't understand. Your cousin tells you about a can't-miss crypto opportunity. Your friend's uncle needs investors for his restaurant. Someone pitches you on a multi-level marketing scheme disguised as a business opportunity. If you don't understand exactly how the investment will make money, don't do it. Stick to opportunities where you can evaluate the business model, assess the risks, and make informed decisions. Mistake number 5, not investing in yourself first. Many people want to immediately invest in external opportunities when the highest return investment is in themselves. The $5,000 spent on developing a skill that increases your income by $20,000 per year is a 400% annual return. No stock or business will beat that. Before you invest in external assets, make sure you've maximized your own earning potential through skill development, education, and personal growth. Chapter 25, the multiplication phase. Once you've deployed your first $20,000 successfully, the next phase is multiplication. This is where wealth actually gets built. Let's say you invested $10,000 in a business or income-producing asset. After a year, that investment has generated $30,000 in profit. Now you have $50,000. Your original $20,000 plus $30,000 in returns. Most people would celebrate and spend some of the profit. Don't. This is the critical moment where you need to reinvest aggressively. Take that $30,000 in profit, keep $5,000 for lifestyle improvement, you've earned it. Reinvest $25,000 in expanding what's working. Now you're deploying $35,000 instead of $10,000. If you maintain the same return rate, next year you generate $105,000 in profit. You keep $20,000 for lifestyle. Reinvest $85,000. By year 3, you're deploying $120,000 in capital and generating $360,000 per year in profit. This is how people go from $20,000 to millionaire in 5 to 7 years. They don't spend their profits, they reinvest them. They let the compounding work. The pattern is year 1, $20,000 to $50,000. Year 2, $50,000 to $150,000. Year 3, $150,000 to $450,000. Year 4, $450,000 to $1 million plus. This assumes you're getting 3 times returns on deployed capital. Which sounds aggressive, but is absolutely achievable when you're investing in businesses, skills, and high return opportunities rather than traditional investments. The key principles: deploy most of your capital, always. Money that's working generates returns. Money that's sitting does nothing. Reinvest profits aggressively in the early years. You can enjoy wealth later. Right now, focus on building it. Double down on what works. If one investment or business is generating great returns, put more money into it. Don't diversify prematurely. Keep learning and adapting. The strategies that work to get from $20,000 to $100,000 might not work to get from $100,000 to $1 million. Keep educating yourself, protect the downside, always maintain an emergency fund, never risk money you can't afford to lose. Take calculated risks, not desperate ones. Section 7. The mindset shifts that matter. Chapter 26. From consumer to producer. The most fundamental shift that happens at $20,000 is the transition from being a consumer to being a producer. When you're broke, you're primarily a consumer. You consume products, services, entertainment, and content that other people create. Your money flows outward to producers who capture it. You're on the wrong side of the economic equation. Think about your daily life. You wake up and check Instagram, consuming content that makes Facebook money. You get coffee at Starbucks, consuming a product that makes Starbucks money. You watch Netflix, consuming entertainment that makes Netflix money. You buy stuff on Amazon, consuming products that make Amazon and sellers money. Every transaction, you're the consumer. Money flows from you to producers. This is fine for some things. You need coffee and entertainment. But if this is your entire economic relationship with the world, you'll never build wealth. Wealthy people are primarily producers. They create products, services, content, or value that other people consume. Money flows from consumers to them. They're on the right side of the economic equation. Here's what changes at $20,000. You finally have enough capital to become a producer at scale. Before $20,000, you might want to start a business, but you can't afford inventory, marketing, or tools. You might want to create content, but you can't afford equipment or software. You might want to offer services, but you can't afford to invest in training or building a client base. You're stuck consuming because you can't afford to produce. After $20,000, you can invest $8,000 in starting a product business. You can spend $3,000 on equipment to create professional content. You can invest $5,000 in learning skills that let you offer high-value services. You can afford to produce, not just consume. This shift is psychological as much as financial. When you start producing, you see the world differently. You watch YouTube and think, I could create content like this. You see successful businesses and think, I could build something similar. You notice problems and think, I could solve that for money. You see opportunities everywhere because you have capital to act on them. Producers have a completely different relationship with money than consumers. Consumers see money as scarce. There's only so much, and spending it means it's gone. Producers see money as abundant. There are infinite ways to create value and capture money in exchange. The transition from consumer to producer is the single most important mindset shift in wealth building, and $20,000 is typically the amount of capital where this transition becomes practically possible. Chapter 27. The Abundance versus Scarcity Mindset. Let's go deeper on mindset because this is where most people fail, even when they have the capital. Scarcity mindset believes there's not enough to go around. If someone else wins, I lose. I need to grab opportunities before they disappear. Spending money means losing money. Taking risks is dangerous. I need to protect what I have. Abundance mindset believes there's more than enough for everyone. Other people's success doesn't diminish mine. Good opportunities appear regularly. Spending money strategically creates more money. Calculated risks create wealth. The best way to protect wealth is to grow it. When you're broke, scarcity mindset is rational. Resources are limited. There isn't enough to go around in your personal economy. You do need to protect every dollar, but here's the trap. If you maintain scarcity mindset even after you accumulate capital, you'll sabotage yourself. You'll be too afraid to invest, too protective of your money, too risk-averse to seize opportunities. The mindset that helped you save $20,000 will prevent you from turning it into $200,000. This is why many people save money but never build wealth. They accumulate capital but operate from scarcity, so they never deploy it effectively. Practical examples of scarcity versus abundance. Scarcity. I can't afford to spend $2,000 on a course. What if it doesn't work? I'll have wasted money. Abundance. If this $2,000 course teaches me skills that increase my income by even $500 per month, it pays for itself in 4 months and generates returns forever, that's an incredible investment. Scarcity. I shouldn't hire help. I can do it myself and save money. Abundance. Hiring help for $1,000 frees up 40 hours I can use to generate $3,000. That's a $2,000 net gain. Not hiring help is actually costing me money. Scarcity. I need to save this money in case something goes wrong. Abundance. I'll keep 25% as an emergency buffer and deploy 75% strategically. If something goes wrong, the 25% covers it. If things go right, the 75% generates returns that more than compensate for any risk. Scarcity. That person has a successful business in my space. There's no room for me. Abundance. That person's success proves the market exists. If they can succeed, so can I. Possibly with a slightly different approach. The shift from scarcity to abundance is hard because it requires operating from faith rather than fear. You have to believe that opportunities exist, that you can create value, that money spent wisely returns multiplied. But this shift is non-negotiable if you want to build wealth. You can't build wealth while simultaneously being terrified of losing it. Chapter 28. Understanding Asymmetric Risk. This is one of the most important concepts in wealth building, and it's something you can only really exploit once you have capital. Asymmetric risk means the potential upside is much larger than the potential downside. You risk a little to potentially gain a lot. Symmetric risk, invest $10,000, might make $12,000 or lose $10,000. Risk and reward are roughly equal. Asymmetric risk, invest $10,000, might lose $10,000 or make $100,000. Risk is capped at what you invest, but upside is 10 times or more. Wealthy people are obsessed with finding asymmetric opportunities. They take dozens of small bets where the downside is limited but the upside is massive. Most bets fail or break even, but the few that hit big more than compensate for all the losses. When you're broke, you can't play the asymmetric game because you can't afford even the small losses. You need every dollar you have, so you can't risk losing any of them. But with $20,000, you can start making asymmetric bets. Example 1, starting a business. Downside, you invest $10,000 and it fails. You lose $10,000 but gain valuable experience. Upside, the business succeeds and generates $100,000 per year in profit for the next decade. That's $1 million in value from a $10,000 investment. Risk/reward ratio, 1 to 100, massively asymmetric. Example 2, learning a high-income skill. Downside, you invest $3,000 in training and don't immediately monetize it, you're out $3,000. Upside, the skill increases your income by $30,000 per year for the rest of your career. Over 20 years, that's $600,000 in additional earnings. Risk/reward ratio, 1 to 200, incredibly asymmetric. Example 3, creating a digital product. Downside, you invest $5,000 and 100 hours creating a course that nobody buys. You lose $5,000 and time. Upside, the course sells to 1,000 people at $200 each over the next 5 years. That's $200,000 from a $5,000 investment. Risk/reward ratio, 1 to 40, very asymmetric. Example 4, angel investing. Downside, you invest $5,000 in a friend's startup and it fails. You lose $5,000. Upside, the startup succeeds and your $5,000 becomes $150,000 when they exit. Risk/reward ratio, 1 to 30, highly asymmetric. The key is that you're never risking money you can't afford to lose, but the potential upside is life-changing. You're making bets where being right once makes up for being wrong 9 times. This is completely different from how broke people think about money. Broke people make symmetric bets, trade an hour for $20, buy lottery tickets, terrible odds, or avoid risk entirely, zero upside. Having $20,000 lets you start playing the asymmetric game, which is the only game where ordinary people become wealthy. Chapter 29, the long-term thinking advantage. Short-term thinking is expensive. Long-term thinking is profitable, but you can only think long-term when you're not in survival mode. When you're broke, your time horizon is days or weeks. How do I pay rent this month? Where's my next meal coming from? Can I afford gas to get to work? This forces short-term decisions. Take the first job offer because you need income now. Accept low pay because you can't wait for better offers. Work constantly because missing income is terrifying. Avoid investments that take time to pay off. Choose immediate gratification over delayed rewards. These short-term decisions accumulate into a long-term pattern of staying broke. With $20,000, your time horizon extends to years. What do I want my life to look like in 5 years? What skills will be valuable? What investments will compound? What foundation should I build now that pay off later? This enables long-term decisions. Spend 6 months building a business properly instead of rushing to revenue. Invest in skills that take a year to develop but double your income. Create content that takes time to gain traction but generates passive income for years. Build systems that are expensive up front but increase efficiency long term. Choose deferred gratification, knowing the payoff is much larger. Real example, short-term thinking. You need money now, so you take a freelance client at $50 per hour. You work 40 hours per week for them, making $2,000 per week. This is immediate income, which feels good, but you're trading all your time for money. You can't scale. You're stuck at $8,000 per month. In 5 years, you're still making roughly the same amount because you're capacity constrained. Long-term thinking. You have $20,000 saved, so you can afford to invest 6 months building a scalable business. You spend $10,000 on training, tools, and initial marketing. For 6 months, you make very little money while you build systems, create products, and establish processes. Month 7 to 12, you start generating $3,000 per month. Year 2, you're at $8,000 per month. Year 3, you're at $20,000 per month. Year 5, you're at $50,000 per month with a team running most operations. The short-term thinker made more money in months 1 to 6, but by year 5, the long-term thinker is making 6 times more and working less because they built something scalable. This is the power of long-term thinking, enabled by having capital. You can afford to build the right thing slowly instead of building the wrong thing quickly. Chapter 30, From Time Trading to Value Creation. Most people trade time for money their entire lives. They work a job, 40 hours per week for a salary. They freelance X hours at Y rate. Their income is directly proportional to time invested. This seems normal because it's how 90% of people operate, but it's a trap. Time trading has a hard ceiling. You only have 40 to 60 usable hours per week. Even at $100 per hour, you're capped at $4,000 to $6,000 per week or $200,000 to $300,000 per year. And that's if you can actually find enough $100 per hour work to fill all your time. Most people trade time at $20 to $50 per hour, which caps them at $40,000 to $100,000 per year. They work their entire lives and never exceed this range because they're trading time, which is finite. Wealthy people don't trade time. They create value that scales beyond their personal hours. They build businesses that generate revenue without their direct involvement, create products that sell while they sleep, build systems that do work for them, invest in assets that generate cash flow, hire people to multiply their efforts. Their income isn't tied to their hours. They can make $10,000 while sleeping, on vacation, or working on something else entirely. The shift happens at $20,000 because that's when you can afford to build scalable value. With $15,000, you can create a digital course that sells 24/7, build an e-commerce business with automated fulfillment, start a service business and hire people to deliver the service, create content that generates ad revenue and sponsorships, build software or tools that people pay to use. All of these decouple income from hours worked. You invest time and money up front to create the asset, then it generates revenue indefinitely with minimal ongoing input. The transition looks like this. Phase 1, time trading. You work a job or freelance. Income equals hours times rate. This is your starting point, and it's how you save the initial $20,000. Phase 2, hybrid. You keep your time trading income for stability, but invest your $20,000 in building scalable assets on the side. You work 40 hours per week at your job and 20 hours per week on your business. Phase 3, transition. Your scalable assets start generating meaningful income, $3,000 to $5,000 per month. This reduces your dependence on time trading. You might reduce your job to part-time or take on fewer freelance clients. Phase 4, full scale. Your scalable assets generate more than your time trading income. You quit the job/freelancing entirely and focus on growing the scalable business. Your income is now unlimited because it's not tied to your hours. Phase 5, compounding. You reinvest profits into more scalable assets. You build multiple income streams. You hire people to run operations. You're making $50,000 to $100,000 per month with assets and teams doing most of the work. Most people never get past phase 1 because they never accumulate the capital to start building scalable assets. They're trapped trading time forever. $20,000 is the ticket to phase 2, which is the beginning of real wealth building. Chapter 31: The Network Effects of Capital. Here's something nobody talks about. Having money makes you more valuable to other people, which creates network effects that multiply your opportunities. When you're broke, you don't have much to offer in relationships. You can offer your time and effort, which is valuable, but you can't invest in opportunities, you can't partner on projects requiring capital, and you can't help others financially. This limits the types of relationships you can build and the circles you can access. But when you have $20,000, you become more valuable to others. To entrepreneurs, you can be an investor or partner. Entrepreneurs need capital, and if you have it, you're valuable. This gets you into conversations and opportunities that wouldn't exist otherwise. To other investors, you can participate in group investments or syndications. Many opportunities require minimum investments of $10,000 to $25,000. Having capital makes you eligible. To service providers, you're a valuable client. Agencies, consultants, and experts want to work with clients who can actually afford to pay. Having capital makes you an attractive client, which means better service and priority access. To communities, high-level masterminds and groups often have financial thresholds, not explicitly, but implicitly. The conversations and opportunities in a $10,000 per year mastermind are completely different from free Facebook groups. These network effects compound. Being in valuable rooms leads to valuable relationships, which lead to valuable opportunities, which lead to more capital, which gives you access to even more valuable rooms. Concrete example, you have $15,000 to invest. A successful entrepreneur in your network is raising money for a new venture. They need 10 investors at $15,000 each. You invest. Now you're a part owner in their business. In a group chat with 9 other investors who are successful and connected, getting insights into how they build and scale businesses, meeting people they introduce you to. Invited to events and opportunities they share with their network. From that one $15,000 investment, you've gained access to a network that could generate millions in opportunities over the next decade. You've bought your way into a room that compounds your opportunities exponentially. Without the $15,000, you're not in that room. You don't meet those people. You don't get those opportunities. Your network stays small, and so do your opportunities. This is why the phrase, "it takes money to make money," is true. It's not just about investing money in assets. It's about how having money gives you access to networks and opportunities that multiply your ability to create wealth. Chapter 32: The Confidence That Comes from Options. Confidence is underrated in wealth building, and real confidence doesn't come from affirmations or mindset work. It comes from having options. When you're broke, you lack confidence in situations that matter. Negotiating salary, you need the job, they sense it. Pitching to clients, you need the contract, they sense it. Making business decisions, you're afraid of being wrong because you can't afford mistakes. Networking with successful people, you feel inferior because you're struggling. This lack of confidence is rational. You're negotiating from weakness because you literally have no options. Any observer can sense your desperation, and it undermines your position. But when you have $20,000, something shifts. You know you have options, and this knowledge changes how you show up. In salary negotiations, you can walk away if the offer isn't right. This isn't a bluff. You actually can afford to keep looking. This confidence makes you a better negotiator. You state your requirements calmly, you don't flinch at silence, you're willing to push back. Employers sense this and often meet your requirements. In client pitches, you're not desperate for the work. You're evaluating whether the client is a good fit for you, as much as they're evaluating you. This shifts the dynamic. You ask harder questions, you set boundaries, you charge more. Clients respect this and often agree to better terms. In business decisions, you can afford to make mistakes and learn from them. This reduces decision paralysis. You make decisions faster, execute, learn what works, and iterate. Your business moves faster than competitors who are paralyzed by fear. In networking, you're not networking from a position of need. You're genuinely interested in building relationships, not desperately trying to extract value from people. This makes you more attractive to high-value people who are tired of being used. This confidence creates a self-reinforcing cycle. You have capital, you feel confident, you negotiate better, you get better opportunities, you make more money, you feel more confident. The cycle continues. Meanwhile, the cycle for broke people runs in reverse. You're broke too, you feel desperate. Arrow. You negotiate poorly. Arrow. You get worse opportunities. Arrow. You make less money. Arrow. You feel more desperate. Arrow. The cycle continues. The $20,000 doesn't just give you financial options, it gives you psychological confidence that changes every interaction. And in a world where so much of success depends on how you show up in high-stakes situations, this confidence is worth as much as the money itself. Section 8. The Strategic Deployment. Chapter 33. The 70-20-10 Deployment Rule. Now let's get extremely practical. You have $20,000. How should you actually deploy it? Here's the framework I recommend. 70-20-10. 70%, $14,000. Income-producing investments. This is money you deploy in opportunities that generate cash flow relatively quickly. The goal is to turn this into $28,000 to $50,000 within 12 to 18 months. Options. Starting or buying a business. Investing in skills that directly increase your income. Buying equipment or assets you can rent out. Creating products you can sell. Funding marketing for your business. The key is that this money should generate returns within months, not years. You need to see your capital growing to maintain momentum and confidence. 20%, $4,000. Learning and network investments. This is money you invest in yourself and relationships. The returns are less direct but often higher long term. Options. Courses and training from people who've achieved what you want. Coaching or mentorship from experts. Joining masterminds or high-value communities. Attending conferences or events. Books, seminars, and skill development. This money compounds over your entire career. The skills you learn and relationships you build at 25 create opportunities until you're 65. The ROI is infinite but delayed. 10%, $2,000. Emergency buffer. This is money you don't touch unless there's a genuine emergency. It's your psychological safety net that allows you to take risks with the other 90%. This might seem small, but remember, you should have additional emergency savings beyond your $20,000 investment capital. This $2,000 is specifically within your deployment capital as a last resort buffer. Why this split works. The 70% deployed in income-producing assets generates returns quickly, which proves the concept and creates momentum. You see your money growing, which builds confidence and teaches you what works. The 20% in learning and networks creates long-term compounding that isn't visible immediately but pays off exponentially over time. 5 years from now, the relationships and skills from this investment will be generating more value than the 70% income-producing assets. The 10% buffer gives you permission to be aggressive with the other 90%. You're not risking everything, so you can make bold moves without paralyzing fear. Anti-example, what not to do. Don't put all $20,000 in stocks/bonds/index funds. The returns are too slow, maybe $2,000 per year. You need faster growth to maintain momentum. Don't keep it all in savings just in case. You'll never deploy it, and inflation will erode its value. The opportunity cost of not investing is higher than any risk from investing. Don't blow half of it on a car, vacation, or lifestyle upgrades. You've worked hard to save this money. Don't consume it before it has a chance to grow. Don't invest it all in one thing. Diversify across 3 to 4 opportunities, so if one fails, others can still succeed. Chapter 34. Identifying high ROI opportunities. Not all opportunities are equal. Some will 10 times your money, others will lose it. Here's how to identify which is which. Characteristics of high ROI opportunities. 1. You have an unfair advantage. The best investments are in areas where you have knowledge, skills, or access that others don't. If you know e-commerce and see an opportunity to start a store in an underserved niche, that's better than randomly investing in real estate where you have no expertise. 2. The market is proven. You're not trying to create demand, you're capturing existing demand more effectively. There's already a market of people paying for solutions. you're just offering a better solution. 3. Low customer acquisition cost. You can reach customers cheaply through organic methods, referrals, or inexpensive paid channels. If you need to spend $100 to acquire a customer who pays you $50, the math doesn't work. 4. High lifetime value. Customers pay you multiple times, not just once. Subscription businesses, repeat service businesses, and products with ongoing consumables have higher lifetime value than one-time purchases. 5. Scalable without proportional cost increases. Digital products scale infinitely. Service businesses that can hire people to deliver service scale. Rental businesses scale with each additional unit. Things that require your personal time for every transaction don't scale. 6. Short time to profitability. You're not burning capital for years hoping something works. You can test the concept with $2,000 to $5,000 and see results in 30 to 90 days. If it works, you scale. If not, you pivot. 7. Asymmetric risk/reward. You're risking $5,000 to potentially make $50,000 plus. The downside is limited, the upside is large. Examples of opportunities that typically meet these criteria: service businesses in high-demand niches, digital marketing, bookkeeping, executive coaching, specialized consulting. Low startup costs, immediate revenue possible, scalable with hiring. E-commerce in validated niches, products that are already selling well, you're just competing on quality, branding, or targeting. The market is proven, you're capturing share. Digital products in your area of expertise, courses, templates, tools that solve problems you've solved before. Low creation cost, infinite scalability, passive income. Buying cash-flowing small businesses, someone built it, it's profitable, they want to sell. You're buying revenue and customers, not starting from scratch. Examples of opportunities that typically don't meet these criteria: restaurants or retail locations, high overhead, long hours, thin margins, dependent on location, difficult to scale. Inventory-heavy businesses without clear demand. You buy $15,000 of inventory hoping it sells. If it doesn't, you're stuck with worthless product. Businesses requiring specialized expertise you don't have. You invest in real estate development but have no construction or real estate experience. You're at the mercy of others. Ground floor opportunities in unproven markets, MLMs, crypto schemes, be your own boss, franchises that require huge ongoing fees. The pattern is clear. Invest in proven markets where you have advantages, can reach customers cheaply, and can scale without proportional cost increases. Chapter 35. The Testing and Scaling Framework. Here's how to deploy capital intelligently. Test small, then scale what works. Most people do it backwards. They invest heavily up front, commit to one approach, and hope it works. If it doesn't, they've lost everything. This is gambling, not investing. Smart deployment looks like this. Phase 1. Test. $2,000 to $3,000 per idea. You have 3 business ideas. Instead of investing $15,000 in one, invest $2,000 to $3,000 testing each. For a product business, buy small inventory or use print on demand. Create basic marketing. Drive some traffic. See if people buy. For a service business, create a basic website. Do some outreach. Offer services at a slight discount to get first clients. See if you can deliver results. For a digital product, create a minimum viable version. Launch to a small audience. See if people buy and find value. You spend $6,000 to $9,000 total testing 3 ideas. 2 fail or break even. 1 shows promise. People are buying. The unit economics work. Customers are happy. Phase 2. Validate. $5,000 to $8,000. You take the idea that showed promise and invest more. You improve the product, refine the marketing, systematize the delivery. You're validating that the initial success wasn't a fluke. If it continues working, you've now validated a real business. If it stalls or fails, you've only lost $7,000 to $11,000 total, and you learned what doesn't work. Phase 3. Scale. Remaining capital plus profits. The business is validated. You're generating revenue. Unit economics are positive. Now you invest aggressively to scale. You spend $10,000 on marketing to 10 times your customer base. You hire people to handle operations. You invest in tools and systems. You're putting fuel on a fire that's already burning. This is when you deploy the bulk of your capital because you're no longer guessing. You're scaling something that's already proven to work. Why this works? You're not betting everything on one idea. You're testing multiple ideas cheaply, then doubling down on winners. Most successful entrepreneurs failed 2 to 3 times before something worked. This framework lets you fail cheaply and succeed big. Why most people don't do this? It requires patience. It's less exciting than going all in immediately. It means accepting small losses during testing phase, but it's how you turn $20,000 into $200,000 reliably instead of gambling and probably losing it all. Chapter 36, Building Systems, Not Jobs. The biggest mistake people make when deploying capital, they build themselves a job instead of building a system. They start a business but end up working 60 hours per week for the same income they could make working 40 hours for someone else. They've traded one job for another, just with more stress and no benefits. This is not wealth building. This is just expensive self-employment. When you deploy your $20,000, your goal should be building systems that work without you. What a system looks like: automated marketing that brings customers without your constant effort, standardized processes that anyone can follow, people handling operations while you handle strategy, products that sell while you sleep, passive income streams that require minimal maintenance, how to build systems from the start, document everything, every task you do, write down the process. This lets you eventually hand it to someone else or automate it. Automate where possible. Use software for scheduling, email marketing, customer management, invoicing, social media posting. Spend money on tools that save you time. Hire for your weaknesses. You're bad at graphic design. Hire a designer. You hate bookkeeping. Hire a bookkeeper. You're slow at writing. Hire a writer. Your time should be spent on the 20% of activities that generate 80% of results. Create leveraged assets, digital products, content, intellectual property, things that can be sold or used infinite times without additional effort. Build once, use repeatedly. Create templates, systems, and processes that work for every client. Or customer, not custom solutions every time. Example, service business done wrong. You start a social media management business. You invest $10,000 in sales and marketing. You get 10 clients at $1,000 per month each. You're making $10,000 per month. Sounds great, but you're personally managing all 10 accounts 60 hours per week. You're trapped. You can't take vacation. Clients need service. You can't grow. You're at capacity. You've built a job, not a business. Example, service business done right. You start the same business but build systems from day one. You invest $3,000 in training team members. You create standardized processes and templates. You hire 2 people at $3,000 per month each to deliver the service. Now your 10 clients generate $10,000 per month revenue. You pay $6,000 in labor costs. You net $4,000 per month profit and work 10 hours per week managing the team. Plus, you can now scale. Add 10 more clients, hire 2 more people, double your profit to $8,000 per month. Add 20 more clients. Now you're making $16,000 per month and working 15 hours per week. Same business, completely different structure. One is a job with a ceiling, the other is a system that scales. When deploying your $20,000, always ask, am I building a system or am I building myself a job? Only invest in systems. Section 9, The Psychological Game. Chapter 37, Dealing with the Fear of Losing It. Let's address the elephant in the room. Once you save $20,000, you'll be terrified of losing it. This fear is normal and healthy in small doses. It prevents reckless decisions. But if the fear paralyzes you, it defeats the entire purpose of having capital. I see this constantly. People save $20,000, then refuse to deploy it because they're terrified of making the wrong decision. The money sits in a savings account earning 1% while they agonize over what to do with it. A year passes, then 2 years, then 5. They've saved money, but built zero wealth because fear prevented them from acting. Here's how to manage this fear. 1. Accept that losses are part of the game. Every successful investor has losing investments. Every successful entrepreneur has failed businesses. You will lose money on some bets. This is normal. The goal isn't to never lose. It's to make sure your winners outweigh your losers. 2. Define acceptable loss before investing. Before deploying any capital, decide, I'm comfortable losing $5,000 on this bet. Once you've mentally written it off, the fear dissipates. You're not making a scared decision, you're making a calculated one. 3. Start with small bets. Don't deploy all $20,000 immediately. Start with $2,000 to $3,000 on a single opportunity. Get comfortable making decisions with capital. Build confidence through small wins before making bigger bets. 4. Focus on learning, not just returns. Even failed investments teach you valuable lessons. A $3,000 loss that teaches you important business lessons is worth more than $3,000 sitting in a savings account teaching you nothing. 5. Remember the opportunity cost. Yes, you might lose $5,000 investing in a business, but keeping it in savings also loses you money, to inflation, and more importantly, to opportunity cost. The business you didn't start could have made you $100,000. The opportunity cost of inaction is higher than the cost of most failures. 6. Keep perspective. You saved $20,000 once. If you lose some of it, you can save it again. You're not starting from zero. You have skills, experience, and knowledge that made saving $20,000 possible. You can do it again and faster the second time. The mental reframe that helps. Don't think, I have $20,000 to protect. Think, I have $20,000 to deploy strategically to build wealth. The first mindset makes you conservative and protective. The second makes you strategic and action-oriented. Both acknowledge the value of money, but only one leads to wealth building. Chapter 38. The Comparison Trap. Once you hit $20,000, you'll notice something annoying. Other people have more. Your friend has $50,000 saved. Your colleague just sold their business for $200,000. Someone on social media is posting about their $1 million net worth. Suddenly, your $20,000 feels insignificant. This comparison trap will destroy your momentum if you let it. Here's what you need to remember. 1. Most people have zero. The median American has about $5,300 in savings. If you have $20,000, you're ahead of 60 to 70% of Americans. You're not rich, but you're not average. You're in a better position than most. 2. Everyone's timeline is different. That person with $200,000 might be 10 years older than you, or they inherited money, or they got lucky with one investment. Their timeline isn't your timeline. Focus on your own progress. 3. The next milestone gets easier. Getting from $0 to $20,000 is the hardest. Getting from $20,000 to $50,000 is easier because you have capital working for you. Getting from $50,000 to $200,000 is even easier because of compounding. The first milestone is always the hardest. 4. Social media is fake. People post their wins and hide their losses. That person posting about their $1 million net worth probably isn't mentioning their $400,000 in debt or the inheritance they started with. Don't compare your reality to someone else's highlight reel. 5. Comparison is the thief of joy. There will always be someone with more. If you hit $100,000, someone has $500,000. If you hit $1 million, someone has $10 million. The comparison game never ends, and it prevents you from appreciating your own progress. The mindset shift: stop comparing up, looking at people ahead of you. Start comparing down, looking at where you used to be. You were at $0. Now you're at $20,000. That's progress. You were struggling to save. Now you have options. That's progress. You were living paycheck to paycheck. Now you have a buffer. That's progress. Celebrate where you are while working toward where you want to be. Comparison prevents both celebration and progress. Chapter 39. When to spend and when to reinvest. One of the hardest decisions after hitting $20,000 and starting to generate returns: should you enjoy the money or reinvest everything? The hustle culture answer is reinvest everything for years until you're wealthy, then enjoy it. The life is short answer is enjoy some now because you might die tomorrow. The right answer is somewhere in between, and it depends on your age and goals. If you're young, 20s to early 30s, reinvest aggressively. You have time and energy. You don't have major obligations. The money you reinvest now compounds for decades. This is your best opportunity to build wealth. Reinvest 80 to 90% of profits. Allow yourself 10 to 20% for lifestyle improvements and enjoyment. This keeps you motivated without completely deferring happiness. If you're middle-aged, Late 30s to 40s? Balance growth with living. You might have kids, a family, responsibilities. Completely deferring gratification isn't realistic or healthy. Reinvest 60 to 70% of profits. Use 30 to 40% for lifestyle, experiences with family, and creating memories. You're building wealth but not sacrificing your present for your future. If you're older, 50 plus. Unless you're starting from zero, shift toward enjoying the money. You've presumably been building for decades. At this point, experiences and time with loved ones might matter more than maximizing net worth. Reinvest 30 to 50% of profits. Use 50 to 70% for lifestyle, travel, helping family, and enjoying the wealth you've built. The key principle? Never let lifestyle inflation eat all your profits. If your business starts generating $10,000 per month profit, don't immediately upgrade your lifestyle to spend $10,000 per month. Keep your lifestyle relatively stable and reinvest the majority of growth. If you were living on $4,000 per month before, maybe increase to $5,000 per month and reinvest the other $5,000. This lets you enjoy some benefits while still compounding wealth aggressively. The anti-pattern to avoid: you start making more money and immediately upgrade everything. Nicer apartment, nicer car, expensive restaurants, luxury purchases. Your expenses rise to match your income. You're making more, but saving the same or less. You're on a treadmill, just at a higher speed. This is how people make $500,000 per year and still have no wealth. Their lifestyle consumed everything. Don't let this happen. Chapter 40. The marathon mindset: building wealth from $20,000 to financial freedom is a marathon, not a sprint. This section is about maintaining momentum over years, not months. Year 1, you're excited, everything is new. You're deploying capital, testing ideas, learning constantly. Energy is high, progress feels fast even when it's slow. Year 2, reality sets in. Some bets didn't work. Progress is slower than you hoped, the novelty has worn off. This is when most people quit. Don't. Year 3, if you've persisted, things start compounding. The skills you learned, the systems you built, the relationships you developed, they're all working together. Progress accelerates. Year 4 to 5, compound effects are obvious. Your income has multiplied. Your net worth has grown significantly. Opportunities find you. Things that were hard 2 years ago are easy now. Year 5 plus, you've built real wealth. Multiple income streams, significant assets, financial freedom or close to it. The patience paid off. Most people quit in year 2 when things get hard. The ones who persist to year 3 and beyond win. How to maintain marathon mindset. 1. Celebrate small wins. Every $1,000 increase in net worth, every new client, every system that works, acknowledge it. Small wins maintain motivation. 2. Track progress. Monthly or quarterly, review where you were and where you are now. When you're in the middle of the marathon, it's hard to see progress. Tracking shows you how far you've come. 3. Adjust, but don't quit. If something isn't working, try a different approach, but don't quit the overall mission of building wealth. Persistence doesn't mean doing the same thing forever, it means staying committed to the goal while adapting tactics. 4. Build support systems. Connect with other people building wealth. Join communities. Find accountability partners. The journey is easier with others. 5. Remember why you started. Financial freedom, options, security, not being forced into decisions by money. Keep your why visible so you don't lose sight of it when things get hard. The truth about wealth building: it's boring most of the time. It's not glamorous. It's making consistent decisions over years. Saving when you want to spend, reinvesting when you want to enjoy, working when you want to rest. But the payoff, actual financial freedom, real options, permanent security, is worth every boring day and every hard decision. $20,000 is your starting, nor line. The marathon begins now. Conclusion. We've covered a lot. Let's bring it all together. $20,000 is the amount where everything changes. Not because you're rich, you're not, but because you finally have enough capital to play the wealth-building game. Below $20,000, you're stuck in survival mode, making desperate decisions, trading time for money, and constantly stressed about money. You're playing defense, trying not to lose. At $20,000 and above, you switch to offense. You can take calculated risks. You can invest in opportunities. You can delegate. You can think long term. You can build systems. You can say no to bad opportunities and yes to good ones. The money itself isn't magic. What's magic is the optionality, leverage, and psychological freedom it provides. Here's what you need to do. If you're below $20,000, make getting there your number one financial priority. Cut expenses ruthlessly. Increase income aggressively. Save every dollar possible. This is your most important financial goal right now because everything else becomes easier once you hit it. If you're at or near $20,000, deploy strategically. Use the 70-20-10 rule. Test small, scale what works. Build systems, not jobs. Focus on asymmetric opportunities. Reinvest most profits. Be patient. This is where you build real wealth over the next 3 to 5 years. If you're past $20,000, keep going. The game gets easier from here. Each milestone compounds faster than the last. $20,000 to $50,000 happens faster than $0 to $20,000. $50,000 to $100,000 happens faster still. Don't stop now. The people who build wealth aren't smarter than you. They're not more talented. They just hit $20,000 and deployed it strategically instead of consuming it or letting it sit idle. You can do this. Save the money. Deploy it wisely. Be patient. Reinvest profits. Build systems. Think long term. The wealth building playbook isn't complicated. It just requires discipline and consistency over time. $20,000 isn't the end goal. It's the beginning. It's the point where you stop being a victim of economic circumstances and start being an active creator of wealth. Everything changes after $20,000. Make sure you get there. Then make sure you use it to build the life you actually want. The game is waiting. It's time to play. Final section, the execution blueprint. Chapter 41, the first 90 days after hitting $20,000. You've saved $20,000. It's sitting in your bank account. Now what? The first 90 days after hitting this milestone are critical because they set the trajectory for everything that follows. Here's exactly what to do. Days 1 to 30, planning and education. Don't touch the money yet. Spend the first month getting clear on your strategy. Week 1, audit your current situation. What are your skills? What markets do you understand? Where do you have advantages? What opportunities are you uniquely positioned to exploit? Write this down. You're looking for the intersection of what you're good at, what people will pay for, and what you're interested in enough to stick with for years. Week 2, research opportunities. Look at 10 to 15 different ways you could deploy capital. Read case studies of people who've done what you're considering. Join communities where these conversations happen. Ask questions. The goal isn't to pick the perfect opportunity. It's to narrow down to 3 to 4 options that seem viable. Week 3, talk to people who've done it. Find 5 people who've successfully deployed capital in ways you're considering. Offer to buy them coffee or pay them for 30 minutes of advice. Ask what they wish they'd known when starting. Ask what mistakes they made. Ask what they'd do differently. This $200 to $500 investment in learning from others' experience will save you thousands in mistakes. Week 4, create your deployment plan. Decide how you'll split your $20,000 based on the 70-20-10 framework we discussed. Write down specific opportunities you'll invest in, how much you'll allocate to each, and what success metrics you'll use to evaluate them. This isn't set in stone. You'll adjust as you learn, but having a plan prevents reactive, emotional decisions. Days 31 to 60, initial deployment. Now you start moving money strategically. Week 5 to 6, make your first investment in yourself. This might be a $3,000 course, a $2,000 conference, or $4,000 in coaching. Whatever develops skills or relationships fastest. Don't skip this step. The ROI on self-investment is higher than any other investment at this stage. Week 7 to 8, start testing business opportunities. Deploy $2,000 to $3,000 in your first test. This might be inventory for e-commerce, initial marketing for a service business, or equipment for content creation. The goal is to validate the concept, not to build the entire business. You're testing whether the dog will eat the dog food. Days 61 to 90, evaluation and adjustment. By day 60, you have initial data. Some things are working, others aren't. Week 9, analyze ruthlessly. What's working better than expected? What's failing? What are you learning? Be honest about results, not about effort. You might have worked hard on something that's clearly not working. That's okay. Cut it. Week 10, double down on signals of success. If something is showing promise, people are buying, clients are happy, you're seeing traction, invest more. Take money from the things that aren't working and reallocate to what is. Week 11 to 12, refine and systematize. Take what's working and start building systems around it. Document processes, create templates. Think about how you'd scale this if it keeps working. By day 90, you should have invested in your own skills and network, $3,000 to $4,000. Tested 2 to 3 business opportunities, $4,000 to $6,000 spent. Identified which opportunities show the most promise, built initial systems for what's working. Maintained your emergency buffer, $2,000. Kept opportunity capital for quick deployment, $4,000 to $5,000. You're not wealthy yet, but you're in motion. You're learning what works for you specifically. You're building momentum. This is exactly where you should be. Chapter 42, the common failure modes and how to avoid them. Let's talk about how people fail after hitting $20,000 so you can avoid these traps. Failure mode. Number 1, analysis paralysis. They save $20,000 and then spend 2 years researching opportunities. They read every book, watch every YouTube video, join every course, but never actually deploy capital. They're so afraid of making the wrong choice that they make no choice. How to avoid it? Set a deadline. By day 90, you must have deployed at least 50% of your capital. Perfect information doesn't exist. You have to act with incomplete information and learn by doing. Failure mode number 2, shiny object syndrome. They deploy $3,000 in opportunity A. After 2 months, they see opportunity B and it looks better, so they abandon A and chase B. Then opportunity C appears and they chase that. They spread effort across too many things and never give anything enough time to work. How to avoid it? Commit to 6 to 12 months on your primary opportunity before pivoting. Yes, some things fail quickly and should be cut, but most opportunities need 6+ months to show real results. Don't mistake slow progress for failure. Failure mode number 3, lifestyle inflation. They save $20,000, feel rich, and immediately upgrade their lifestyle. New car, nicer apartment, expensive habits. Within a year, the $20,000 is gone and they're back at zero, just with higher expenses. How to avoid it? Maintain your lifestyle for at least 12 months after hitting $20,000. Let the capital work before you consume any of it. Once it's generating returns, you can upgrade lifestyle slightly, but never let lifestyle inflation eat your capital or your profits. Failure mode. Number 4, following someone else's path. They see someone successful in real estate, so they invest in real estate despite having no interest or skills in it. They're following someone else's playbook instead of finding what works for them. How to avoid it? Deploy capital in areas where you have interest, skills, or advantages. Your path to wealth will be unique to you. Learn from others, but don't copy their exact strategy if it doesn't fit your strengths. Failure mode. Number 5, trying to get rich quick. They invest $15,000 in a guaranteed system or proven method that promises $10,000 per month in 60 days. It's a scam or overhyped course. They lose most of their capital and their momentum. How to avoid it? Be skeptical of any opportunity that sounds too good to be true. Wealth building is boring and slow. If someone's promising fast, easy money, they're lying or selling something. Stick to proven, boring strategies that work over time. Failure mode. Number 6, giving up too early. They deploy capital, it doesn't work immediately, and they quit. They decide, business isn't for me, or I'm not cut out for investing, and go back to their regular job, never trying again. How to avoid it? Expect setbacks. Plan for them. Your first attempt probably won't work. Neither will your second. This is normal. Every successful person failed multiple times before something worked. The only way to guarantee failure is to stop trying. The meta pattern. Most failures come from either not acting, paralysis, fear, or acting rashly, shiny objects, get-rich-quick schemes, lifestyle inflation. The middle path, deliberate action with patience, is what works. Chapter 43, The Life, Waiting on the Other Side. Let's talk about what life looks like 3 to 5 years after hitting $20,000 and deploying it successfully, because this is what you're actually working toward. You've built 2 to 3 income streams generating $8,000 to $15,000 per month combined. Maybe a service business, a digital product, and some freelance work, or an e-commerce business and a content platform. The exact vehicles don't matter. What matters is you have multiple streams that aren't dependent on trading all your time for money. Your net worth has grown from $20,000 to $150,000 to $300,000. You're reinvesting profits, so it's not all liquid, but it's there. You're no longer worried about money day to day. You work 20 to 30 hours per week instead of 60. You've built systems and hired people. Your business runs without you micromanaging every detail. You have time for family, hobbies, health, and things that matter beyond making money. You can take a month off without income stopping. Your systems and team handle things. Your passive income continues. You have the freedom to travel, spend time with aging parents, or just rest without financial stress. You make decisions based on what you want, not what you need financially. Job offers, client projects, business partnerships, you evaluate them on merit, not desperation. You say no to most things and yes to only the very best opportunities. You're building toward financial freedom, the point where investment returns and passive income cover your lifestyle indefinitely. You're not there yet, but you can see the path. Maybe 5 to 7 more years of reinvesting and compounding. You've become the person who has options, who operates from abundance, who helps others. People come to you for advice. You invest in friends' businesses. You create opportunities for others. This is the life waiting. On the other side of deploying $20,000 strategically, it's not private jets and mansions. That's a different level of wealth. But it's freedom, security, and options. For most people, that's the real dream. The best part, looking back, you'll realize the money wasn't the hard part. Saving $20,000 felt impossible when you started, but you did it. The hard part was having the courage to deploy it, the patience to let it compound, and the discipline to reinvest instead of consuming. But you did those things too, and now you're free in ways that most people never experience. Chapter 44, Your Next Move. This video is ending, but your journey is just beginning. If you're below $20,000, you know what to do. Cut expenses, increase income, save aggressively. Make hitting $20,000 your number one financial priority for the next 12 to 24 months. Nothing else matters more than reaching this threshold. If you're at $20,000 or just hit it, the next 90 days determine your trajectory. Plan carefully, deploy strategically, test quickly, and scale what works. The clock starts now. If you're past $20,000, keep going. The momentum you've built will carry you further and faster than you expect. Stay disciplined. Keep reinvesting. Think long term. Wherever you are, remember, wealth isn't built by one massive decision. It's built by thousands of small decisions compounded over years. Save $500 this month. Cut one unnecessary expense. Start one side hustle. Take one course. Make one investment. Each decision seems small, but they compound into life-changing results. The people who build wealth aren't special. They just made better decisions more consistently over longer periods. You can do exactly the same thing starting today. $20,000 is the number that changes everything, but only if you actually get there, and only if you deploy it strategically once you do. Most people will watch this video and do nothing. They'll agree with the concepts, but not change their behavior. They'll stay stuck in the same patterns that keep them broke. Don't be most people. Take action today. Not tomorrow, not next month, today. Open a separate savings account. Set up automatic transfers. Cut one expensive habit. Start one side hustle. Make the first move. Because here's the truth. A year from now, you'll wish you started today. 5 years from now, you'll either have built real wealth, or you'll still be where you are now, wondering when things will change. Things change when you change them. The opportunity is there. The playbook is clear. The only question is whether you'll execute. Everything changes after $20,000. But first, you have to get there. Now go build the life you actually want. The game is waiting, and you know how to play.